Welcome to the Kreston Reeves Financial Reporting and the Future of Audit webinar. This webinar will be hosted by Peter Manza, who is Partner and Head of Audit and Assurance at Kreston Reeves and frequently presents on financial reporting issues. He is Chairman of the firm's Technical Committee for Audit and Assurance Matters, responsible for developing the firm's audit strategy and policies, including implementation of quality control standards. The webinar will last around half an hour and will be followed by a Q&A session. All attendees' phones will be muted throughout the webinar. However, you can ask questions through the pop-up on your screen. This may appear as a small red arrow on the top right of your screen. If you expand this, you will have the functionality to ask questions. All questions will be answered at the end of the webinar, but should we run out of time, your questions will be answered via email. A recording of the webinar will be sent in the next few days. I will now hand you over to Peter.
Well, thank you very much, Rachel, and welcome to our presentation on the financial reporting and the future of auditing. So enough about me, and we'll move on to our agenda. And you'll see that we've had an opportunity to look at the past, the present, and the future. So the theme of our webinar today is look at the past, see how key events have arisen that are shaping the current debate on how audit and financial reporting needs to adapt and change. Then in terms of the present, we'll be looking at some actual financial reporting developments, as well as what may impact upon your reporting in financial statements over the next year or so. And in the future, we'll look at other ways in which audit is changing right now to meet the needs of businesses and also future possible changes to financial reporting standards and how they could impact upon you. So as Rachel has said, if you've got any questions on any of the topics being covered by today's webinar, then please send them through and we'll do our best to answer them as we go along. So unusually then, we see that auditing and financial reporting has been hitting the press, not just in the financial press, but also on the main papers as well. And this is the result of a succession of high-profile corporate scandals and failures hitting the headlines, and often with the auditors being at least partially blamed for the fallout as well. So we see here reference there to Patisserie Valerie cooking the books, Kreston, a big corporate failure there, and of course BHS with a loss of 11,000 jobs, the Guardian states there. Also good to see on the front page of the Guardian, print as well, still a fashion icon, so that's encouraging for some. So BHS, Kreston, and Patisserie Valerie are just three of the names recently that have been in the press a lot and brought a lot of criticism for their auditors. And much of this criticism has been levelled at the top end of the profession, the four big firms, the international firms of KPMG, PwC, EY, and Deloitte. And just this morning, I see that the Financial Reporting Council has levied another fine upon PwC of £6.5 million for an audit failure. So there have been allegations of poor audit quality arising from a lack of scepticism, a focus on more lucrative non-audit services, and the complacency that comes from a lack of competition amongst the big four. Well, we like to think that though these issues are prevalent in the listed market, in terms of the small and medium enterprises, most of you watching today, for example, in the areas that you operate, these issues don't actually arise. Certainly there is no lack of competition in this sector of the market leading to any complacency. Here at Kreston Reeves, we're aware that you have a choice of advisors and that drives our desire to improve standards all the time. So a lot in the press. What has been the reaction? Well, the government has reacted to this despite having other things to occupy them, like Brexit, for example. The reaction, well, we have a number of reviews have been undertaken or in progress that are designed to address these weaknesses that exist in the regulatory framework. So the first one mentioned there, the Competition and Markets Authority, the CMA, they have already reported on ways by which competition between audit firms at the top end of the market amongst the Big Four can be improved. The second one, the Kingman Review, has concluded that the UK needs a brand new regulator to oversee listed companies and the audit profession that is more effective than the Financial Reporting Council that has been in place for a number of years now. The third review mentioned there, the Bryden Review, is looking at the auditing standards themselves and the legislation that underpins them to see if audit is meeting the needs of bond business and whether they need strengthening and how and when. In addition to that, Parliament also has been looking at the audit profession closely. The Business Energy and Industry Strategy Select Committee has undertaken its own inquiry on the future of audit, an inquiry which saw our own former chairman, Clive Stevens of Kreston Reeves, being interviewed by a panel of MPs. As Rachel Reeves, the MP chairing the inquiry, stated, and she said, it's now up to the government to deliver with legislation to ensure that audits provide what businesses, investors, employees, pension holders and the public expect. And that quote just indicates the wide level of interest there is in financial statements and the underlying viability of these large companies. So we'll look more at these reviews later and consider what changes may be in store in the drive to improve the reliability of financial reporting. So firstly then, it's good to remind ourselves exactly what do we mean by audit and what does it seek to achieve. So here we have a definition on the screen from the current auditing standards that shows what auditors are obliged to follow when undertaking their work. Whether it's the largest audit in the company, in the country, or whether it's the smallest company requiring an audit. The same auditing standards have to be followed. So it's helpful to remind ourselves what an audit actually is and what it doesn't cover, because the difference does create this expectation gap in the minds of many, which has fueled some of the press speculation. An audit was all about providing credibility in financial reporting, so that the users of accounts can have confidence that reported results are an accurate reflection of a company's financial performance. That a company's balance sheet is a fair reflection of a company's financial strength and stability, and that all matters that are necessary to have an adequate understanding of the company's financial position have been accurately disclosed in line with current expectations of corporate transparency. But at the same time, we have to be aware that audit does have its limitations. It is not an absolute level of assurance or guarantee, nor can it provide assurance in respect of future viability. Companies can, do, and always have failed, and this will continue. Although audits are planned to detect material misstatements in accounts, however they may arise, they do not provide a guarantee that fraud hasn't occurred. It is these kind of issues that have resulted in this expectation gap arising, and which these reviews are seeking to address. How this can be achieved, we will look at later. Here on the next slide then, we see results of a survey undertaken recently by the Association of Practicing Accountants, a network of 16 leading advisory firms of which we at Kreston Reeves are a part. The purpose of the survey was to help us to gain a better understanding of how business owners view the current economic environment. And one of the questions there addressed audit and what the main benefits of an audit was. And you can see from the results here that by far the biggest response was meeting the statutory obligations. So obviously an audit for many companies is required by law, and that's a key reason why people have an audit. But it's encouraging to see the other results as well. The fact that audit provides a good challenge, that it gives business advisors the opportunity to provide advice and support, and also builds confidence in the business. So there are some tangible benefits of having an audit which we shouldn't lose sight of. There are, of course, alternatives to audit. For companies and LLPs, the requirement of an audit is set out in company law. And if the law says you're required to have an audit, then an audit is required. But for many companies, they can take advantage of audit exemption. So it's worthwhile just taking a second look to remind ourselves of the alternatives to audit. Now, there are no changes to the statutory audit exemption at the moment to advise you of, nor are any planned. But given that these exemption rules are part of the European Union, this could well change post-Brexit. We shall see whether the government further relaxes these in a post-Brexit world. Anyway, at present, these rules are unchanged. A company is eligible to take advantage of audit exemption if it is small in size. This broadly means meeting two of the following three criteria: annual turnover of no more than 10.2 million, gross assets of no more than 5.1 million, and no more than 50 employees. Now, there are special rules for companies that are part of a group, in that the group must comply with the size criteria as well as the individual company. So a small company that is part of a large group will still require an audit, and this includes taking overseas companies into account. There is, though, an alternative for subsidiary companies, provided that audited consolidated accounts are prepared by a EEA-based parent company, and that parent company is willing to provide a guarantee to the company's creditors. Then audit exemption can be taken advantage of regardless of the size of the subsidiary undertaking. We do appreciate, though, that a statutory audit can be limited in scope, ensuring that the accounts show a true and fair view and comply with legal requirements. And this does not necessarily meet all the assurance needs of our clients. That is why audit is just one of the assurance services we are able to provide. And once free of the need to comply with the statutory framework for audit, there can be considerable flexibility in developing an approach to assurance that meets an individual's client needs. The first one, then, is the agreed upon procedures. Here, the work to be performed is discussed and agreed in advance, so as to arrive at a program of procedures and tests that are clear and unambiguous. The accountant will provide detail of factual findings arising from these procedures in the form of a report. A conclusion may not be provided, but value is derived from having an objective review by an independent expert. An agreed upon procedures engagement can be carried out for purely internal purposes. For example, a review may solely focus on stock valuation, as this may be a highly material and subjective area, upon which added assurance is sought. And procedures similar to those in an audit in respect of stock valuation and existence may be undertaken. Additionally, agreed upon procedures can also be used to provide comfort to a third party. For example, they're often used to assess compliance with the terms of a grant funding or in support of covenants compliance in a lending arrangement. The second alternative to audit there is the assurance service. This relates specifically to the financial statements and is primarily designed for companies and other entities that are not required to have a statutory audit, but still wish to present accounts that have some form of independent assurance in order to provide the users of those accounts with added comfort that the accounts are reliable. The work that is performed goes beyond what is required to just prepare the accounts on behalf of management, but will not be as detailed as an audit engagement. Rather, this will focus on inquiries of management, the use of analytical review techniques, with the possibility of additional tests being performed to address any identified concerns. A conclusion is presented in a report that accompanies the financial statements so that anyone that reads them can see that an independent review has taken place. The third alternative listed there is internal audit. This is not so public, and it would involve reporting solely to the entity's management, or if there is one, a separate audit committee. Again, the nature of work to be performed is one of agreement between the client and advisor, and generally would involve reviewing the operation and effectiveness of an area of the entity's system of internal control. Internal audit can go into much greater detail than statutory audit, which is of course focused mainly on material areas. For example, an error in petty cash is unlikely to be material, but may be of interest to management. So it could be an area where errors are commonplace and internal audit could be of real benefit in that kind of situation. So moving away from audit now onto financial reporting and giving you an update on areas here. So it's time to look at a few changes to reporting requirements to advise you of that's coming now and in the future. There's not been many changes, but those that have been brought in could be quite significant. So it's worth taking a look. So financial reporting update. We'll start off by looking at the triennial review of the accounting standard FRS 102 that has recently come into force. Before moving on to what has been happening internationally and how this could affect UK reporting in the future. We'll also look at this in this session at some major changes to narrative accounting and reporting that larger businesses are going to have to address. So let's start then with the triennial review of FRS 102. FRS 102 is the single accounting standard followed by the majority of UK businesses. The standard is due to be reconsidered and updated where required every 3 years. So the first triennial review was completed back in 2017 and was focused on various problem areas that the use of the standard had highlighted and putting changes right. It takes effect for accounting periods commencing on or after the 1st of January 2019, but early adoption is permitted. So for the majority of businesses, this means accounts for the year ended 31st of December 2019 onwards, so it's really current. Or there could be some early years affected by newly incorporated companies or LLPs where they have a different year end. Given that the aim of the triennial review was to deal with problem areas, early adoption may well be an attractive proposition for you. Note that where early adoption is being taken advantage of, your accounts will need to state this fact. If you do choose to early adopt, you are required to adopt all the changes to the standard. You can't just cherry pick the ones you like. There is one exception to this rule in respect of small companies, and we'll look at this shortly. So let's first consider then disclosure changes. We'll break the content of the revised FRS 102 into two segments. Firstly, disclosure changes, and then accounting changes. So firstly, disclosure changes. Small entities continue to be able to adopt the reduced disclosure framework as set out in section 1A of the standard. As a reminder, a small entity is broadly one that meets two of the following three size criteria: turnover 10.2 million, gross assets 5.1, and no more than 50 employees. As the disclosure rules for small entities is set out in legislation, and this hasn't changed, there are no significant changes to the disclosure rules for small entities to advise you of. In addition, small entities continue to also be able to file so-called fledged accounts with the Companies House. That is, with the director's report, profit and loss, and related notes omitted from the accounts filed there. There are some changes, though, to the disclosure requirements for non-small entities to let you know about. Firstly, when FRS 102 was introduced, it became necessary for the first time for the accounts to disclose information on financial instruments held by the company. Broadly speaking, a financial instrument is any contract that we settle in cash, which is quite wide-ranging in scope. It would include, for example, bank overdrafts and loans, trade debtors and creditors, finance leases, accruals, and non-group investments. This disclosure is usually made in a standalone note to the accounts detailing all the financial instruments held. Many commentators thought that this disclosure was onerous, and the standard setters have agreed, such that for many businesses, this disclosure will no longer be required. The requirement has not disappeared entirely, though. Any entity that has financial instruments that are measured at fair value, will still need to include relevant disclosures in their accounts. This will include any entities that hold listed investments, for example, or have derivative arrangements, including foreign exchange forward contracts. Details of these more complex arrangements will still need to be disclosed, including details of how the fair values used have been arrived at. For many businesses, though, there will be one less note to include in the accounts going forward. The second key change is regarding key management compensation. So moving on, there has been a statutory requirement for companies to disclose details of the remuneration paid to directors, and that's been in place for many, many years. When FRS 102 was first introduced, it added the requirement to disclose compensation payable to an entity's key management. As well as having a slight difference in the way the numbers are calculated, FRS 102 requires employers' national insurance contributions to be included in the disclosure. The standard also goes further than the law through its definition of who is included within the definition of key management, which the standard makes clear includes those persons having authority and responsibility for planning, directing, and controlling the activities of the entity. Using this definition, the directors of a company will clearly always be considered to be key management, but it could extend to other key members of staff that have a management role in the organisation. The standard now recognises that for many privately owned businesses, the key management will comprise solely the company directors. And where this is the case, there is no longer any requirement to disclose key management personnel compensation. Directors' remuneration will still need to be disclosed, of course, because that's required by company law, but that disclosure will not need to be repeated elsewhere in the notes to the accounts. There is no change to the disclosure requirements for entities that have members of key management that are not directors. They will still be required to disclose the amount of compensation paid to key management separately from directors' remuneration. The third key change on disclosure is regarding stock or inventories. There is no longer any requirement to disclose the amount of stock recognised as an expense in the notes to accounts. Given that not many businesses are making this disclosure anyway, this won't come as a big change. So far, we have looked at some reductions in the disclosure requirements. There is, though, one significant new disclosure requirement that will impact upon non-small entities, and this relates to the cash flow statement. In support of this primary statement, there is now the need to include, by way of a supporting note, an analysis of the changes in the entity's net debt from the beginning to the end of the reporting period. This is quite similar to a disclosure requirement that existed before the introduction of FRS 102. This reconciliation will highlight the cash transactions that have impacted upon the entity's net debt, such as loan advances, capital repayments, but also show any non-cash changes that have had an impact on the debt position, such as new finance lease entered into, or the effect of foreign exchange fluctuations on non-sterling debt. This disclosure is not required for any entity that isn't required to include a cash flow statement in its accounts, which for non-small entities will primarily be subsidiary undertakings that are taking advantage of the reduced disclosure rules that are available for groups. Moving on then to accounting changes. So leaving disclosure behind, there have been a few changes to accounting requirements as a result of the triennial review of FRS 102. We'll look at some of the most significant, as well as what might be the subject of a future change. So loans from directors. I mentioned earlier that there was one accounting change that could be adopted early without having to adopt all the changes introduced as a result of the triennial review of FRS 102, and this is it, loans from directors. It only relates to small entities as defined earlier, so usually those with turnover less than £10.2 million. Such entities are often financed by loans from the company's directors, and this relaxation to the accounting rules is aimed at them. When FRS 102 was introduced, it provided guidance for the first time that the accounting for loans had to reflect the time value of money. For any loans that had a market rate of interest applied, this wasn't an issue, but it did have major implications for loans that were interest-free. Although we have had relatively low interest rates in the UK for many years now, the complete absence of interest being applied to a loan was not considered to be a market rate loan. Given that it's not unusual for directors to lend money to their companies on very favourable terms, even interest-free, this has affected them significantly. The accounting for non-market rate loans is actually quite complicated and involves discounting the loan using an appropriate interest rate. I won't explain this any further now though. This is mainly because with a little bit of planning, this ceased to be an issue for most entities that were affected. By treating the loans as repayable on demand, these onerous accounting requirements simply went away, although it often did have an adverse impact on the presentation of the balance sheet. Prior to FRS 102 being introduced, it was common to present directors' loans as long-term debt, thereby boosting the company's solvency position as reflected in its net current assets figure on the balance sheet. The standard has now been revised and provides an option for small entities to record loans from directors at transaction price without any discounting required. This includes long-term loans as well as those that are repayable on demand. So there is an opportunity here for some small entities to improve the look of their balance sheet. If considering this, we would recommend that any loan agreement is clearly documented to provide evidence of the repayment terms to support the treatment of directors' loans as a long-term creditor. This relaxation covers loans from directors and their close family members. This includes a director's spouse or domestic partner, children, and other dependents, as well as any other family member who may be expected to be influenced by the director in their dealings with the company. So if they've been willing to advance funds free of any interest, that's a good sign they've been subject to influence from the director and can be included within this exemption. At least one person within the director's family group must be a shareholder of the company. This relaxation of the rules does not apply to directors that do not have any equity interest in the company and are only employees. Moving then on to investment property. This accounting change will only apply to groups of companies. It is a common arrangement within groups that property is held in a separate company from that which undertakes the primary trading activity. Before FRS 102 was introduced, such group property was exempt from the accounting requirements that apply to investment property, namely to recognise them in the balance sheet at their market value. Instead, they were treated as regular fixed assets at cost, less depreciation. FRS 102 changed all of this, recognising for the company holding the property, not undertaking the trading activity, it was in fact an investment and should be treated in the same way as any other investment property. The property will be stated at its fair value, with any changes in that recognised in the company's profit and loss account. The accounting is particularly difficult when the group is required to prepare consolidated accounts, where the property will need to be accounted for in those consolidated group accounts as a regular fixed asset, being at cost less depreciation, resulting in different approaches between group and entity level. Very confusing indeed. The standard now recognises that approach can be unduly onerous, and provides an option for companies at entity level. They can either continue to treat them as investment properties or instead reclassify them as regular fixed assets and account for them under the cost model, at cost less depreciation. Note that the revaluation model is not an option for the entity. If it wishes to show a stronger balance sheet by stating properties at a market value, then treatment as an investment property is the only option for them. For groups that have been affected, they do now have the ability to have a common accounting approach at group and entity level if they wish. The decision to do so, though, is not an easy one, as treatment at entity level as an investment property does have its advantages. Firstly, the ability to present a stronger balance sheet, as just mentioned, but also the possibility of reporting higher profits, as there is no need to provide for depreciation in respect of investment property. If you are affected by this, it's probably worth sitting down with your advisor to discuss the best way forward. Whilst on the subject of investment property, there has been a more general change introduced by the triennial review of FRS 102. The original version of FRS 102 provides an exemption from recognising investment property at its fair value if that fair value could not be measured reliably without undue cost or effort. It was believed that this exemption was being abused, with it being used as an excuse not to value the investment property. So this exemption has now been removed, providing clarity that it's expected that all investment property will be stated at its fair value. Moving on to the next change then, this concerns business combinations. Again, this has been implemented by the triennial review of FRS 102, and again relates primarily to groups, although it may possibly affect entity accounts of individual companies. When FRS 102 was introduced, it significantly changed the accounting for intangible assets that arise on business combinations. This includes both how the acquisition of a company is reflected in group accounts, but also how an individual company accounts for an asset purchase when it acquires the trading assets of a business, rather than the entire company. Provided it could be measured reliably, separate recognition was required for any intangible asset. This resulted in intangible assets such as brands, customer lists, and know-how being recognised for the first time in UK accounting. It is now appreciated that obtaining a reliable valuation for such intangible assets can be a costly process that can have actually little real benefit to a company's accounting. Thus, the rules have been changed such that separate recognition will not only be required for intangible assets that arise from contractual or other legal rights and are considered to be separate, that is, capable of being separated or divided from the entity and disposed of without significantly impacting on the trading activity of the company. For all other intangible assets, separate recognition is now optional, which is good, and this should make accounting for business combinations far easier going forward. Where this relaxation is taken advantage of, the value of affected intangible assets will be subsumed within goodwill and subsequently amortized over its useful life in the usual way. Now let's consider the background of international standards. So far we've been looking at changes to UK accounting standards, but now let's look at the international scene. This won't have any immediate impact on the vast majority of UK businesses, as international standards only apply as mandatory for listed entities, although all companies can adopt them if they wish. However, they do provide an indication of how UK accounting may change and develop in the future in order to keep up the latest changing on international accounting matters. So for accounting periods commencing on or after the 1st of January 2018, there are two new standards that apply for the first time, and both relate to major areas. IFRS 9 relates to financial instruments, and it's taken a long time to arrive, given that its purpose is to address various shortcomings in accounting that helped contribute to the financial crash of a decade ago. Its changes will have some major implications for financial institutions such as banks. But if incorporated into UK GAAP, its impact on SMEs is likely to be fairly minimal. But there is one area that could see some change, and that is how bad debt provisions are calculated, with the introduction of what is known as the expected credit loss model. So at present, a bad debt should only be recognised once it has already gone bad. But the expected credit loss model acknowledges that it's inevitable that some debtors will be unable to pay. So it allows the recognition of a bad debt provision immediately at the point of sale based upon a model of the company's experience in collecting its debts. The second one there, IFRS 15, updates the requirements in respect of revenue recognition and is unlikely to have any significant impact on most businesses, as it continues to be based on the principle that turnover should be recognised as an entity fulfills its contractual obligation and earns a right to be paid for them. I shall skip over IFRS 16 and leasing for the moment and just quickly refer to IFRS 17 and insurance contracts. Although potentially it could impact upon many businesses, it is clearly focused on a specific industry sector. As its implementation date is still a few years away, for accounting periods commencing on or after the 1st of January 2021, we can leave this one for another day. Let's return now to the International Accounting Standard on leases. This takes effect for accounting periods commencing on or after the 1st of January 2019, and compared to the other new standards, is likely to have a significant impact on most businesses that apply the International Accounting Standards. It seeks to address a criticism of current accounting practice that has been around for many years, that often a company's most significant debt obligations, namely those related to leases, are not necessarily included on its balance sheet, and therefore gives a false picture of a company's entity's financial position. The main feature of IFRS 16 is to remove the distinction between operating and finance leases, and to require them both to be reflected on an entity's balance sheet. This will result in existing operating leases being reclassified and having the lease obligation recognized as a debt obligation within creditors for the first time, with a similar right of use asset included within fixed assets. The profit and loss account will now recognize the depreciation of the asset and the finance element of the lease repayments. In other words then, operating leases are being accounted for on the same basis that finance leases are already being recognized. The only exceptions to this are low-value leases and those that have a lease term of less than 1 year. So for some businesses that enter into a lot of leasing arrangements, this can have significant implications. For example, one industry sector that is significantly affected is retail, where a business may have multiple outlets that are being leased, currently as operating leases. Now, we don't know yet whether these changes outlined in IFRS 16 will be reflected in UK accounting. There will be strong support, though, for making the change, not just to retain symmetry with the international approach, but also to address the criticism I referred to earlier, that current practice does not adequately recognise an entity's lease obligations. On that basis, we would speculate that it's highly likely that these changes will be incorporated in a future revision to FRS 102. Let's now consider together some narrative reporting then. The narrative reports that are presented alongside the financial statements are becoming increasingly important as a means of conveying information about a company's performance and the environment in which it operates. This is being enhanced by some significant new changes designed to improve the flow of information to interested stakeholders. All of the new requirements we'll be looking at only apply to large companies, and what they need to include as part of the narrative reporting, either as part of the strategic report or within the director's report. A large company is one that broadly meets two of the following three size requirements: turnover 36 million, gross assets of 18 million, or more than 250 employees. So for accounting periods commencing on or after the 1st of January 2019, so principally December 2019 year ends onwards, it will be necessary to disclose how the directors have complied with their duty to have regard to the matters set out in Section 172 of the Companies Act 2006. Now, this section requires directors to act in a way that they consider is most likely to promote the success of the company for the benefit of its members as a whole, but when doing so, to have regard to other stakeholders, such as employees, suppliers, customers, the community, and the environment. It also requires directors to consider the likely long-term implications of their decisions and the need to maintain a reputation for good standards of business conduct. This statement and this strategic report will need to address three main areas: the issues, factors, and stakeholders the directors consider relevant when complying with their statutory duty and how they have formed that opinion. Secondly, the main methods directors have used to engage with stakeholders and understand the issues to which they must have regard. And thirdly, details of the effect of that regard on the decisions made and the strategies implemented during the year. As well as being included in the strategic report, this statement will also need to be published on the company's website. At the same time that this change, the strategic report, is introduced, there are also two specific new requirements that relate to the director's report. Although, as always, these items can be reflected in the strategic report if preferred. For companies with more than 250 employees, it will be necessary to disclose how the directors have engaged with employees and taken account of their interests. Additionally, large companies will need to include a statement on how the directors have engaged with suppliers, customers, and others in a business relationship with the company. So still staying with narrative reporting for large companies, energy usage. And this is the second of the changes to narrative reporting that we're going to look at. And it's something that is brand new for corporate reporting by non-listed entities. And the need to include disclosure in the annual report of the business's impact on the environment. These new requirements apply for accounting periods commencing on or after the 1st of April 2019, so effectively for March 2020 year-end onwards. Again, these requirements apply to large companies, but they will also apply to large LLPs. The government hopes that many small and medium-sized entities will consider making these disclosures on a voluntary basis. Whether they do or not remains to be seen, and if they don't, whether the government will seek to extend the scope of the legislation, we shall wait and see. For privately owned businesses, these new requirements relate solely to an entity's UK energy consumption, unlike the new rules for listed businesses, which require global figures to be reported. The disclosure will need to incorporate details of the entity's greenhouse gas emissions and energy usage, and guidance has been published by the government on how these figures should be calculated. Details of any energy efficiency initiatives being implemented are also required to be disclosed. For many businesses, this will represent a new area that will need to be reported upon, and they may experience difficulty to compile the information necessary to make adequate disclosure. So if you are caught by these new requirements, it's a good idea to look into them now and ensure that you have in place a way of capturing the necessary disclosure information. So what are the other reporting requirements? So here we have a table. So just a brief reminder then of some of the other reporting issues that have been introduced in recent years away from the annual reporting in the accounts. And you'll see that over the years, there's been quite a few of these that have been introduced. And it's quite a confusing picture, as you can see, as to who they apply to, the different size criteria used, and where they have to be published. So for larger entities, there's a lot to keep tabs on. What about the future then? What can we see coming towards us? Well, we've mentioned some very key significant reviews underway. As mentioned earlier, as a result of recent high-profile corporate failures, we have these reviews into the way that the audit profession is regulated. The focus throughout these reviews has clearly been the audit of public interest entities, such as those listed on the stock exchange. The action that flows from these reviews will have implications for the entire audit profession and their audit clients. For this reason, Kreston Reeves have been quite vocal in ensuring that our views are heard, in order to ensure that any reforms implemented are proportionate, without any additional onus requirements being placed on the SME market. So firstly then, of the reviews being taken place, the Competition and Markets Authority's investigation into the market for audit services has been one that will probably have the least impact upon SMEs, as it seeks to improve audit quality at the top end of the audit market by increasing the level of competition that exists. At present, this is a market that is dominated by the Big Four accountancy firms. The second review, listed there, the Kingman Review, examines how companies and auditors are regulated, and has proposed a brand new regulator, the Audit, Reporting and Governance Agency, or known as ARGA. And this will have considerable more powers than its predecessor, the current Financial Reporting Council. The third one referred to there, the Bryden Review, this changes the way that audits are performed. It has a wide-ranging remit to look at the legal and regulatory framework for audit. And we can see major changes coming as a result of this review. This will involve auditors having to perform more work designed to look for fraudulent activity in particular, and to assess an entity's future viability and its going concern. The future, well, the use of technology marches on. And it would be remiss of me to talk about the future of auditing and not mention some of the ways in which technology is impacting on the way in which we conduct our work. At Kreston Reeves, we've always sought to utilise technology to improve the efficiency and effectiveness of our audit work. Something that has been getting auditors excited over the last couple of years, and which I'm sure we'll all be hearing much more about in the future, is data analytics. For many years now, auditors have had to employ sampling techniques when conducting their work, making judgments about the characteristics of a population based upon a sample of items. For example, it would not be unusual for one of our clients to have hundreds, if not thousands, of different items held in stock at the year end. It can be extremely impractical for the auditor to count every single one of these lines and to ensure that it's been valued correctly, as well as, of course, having great cost implications for the cost of the audit. So instead, we test a sample, and based upon the results of that sample, we make judgments about the population as a whole. Now, data analytics takes a entirely different approach. Instead of testing a sample, we're able to examine an entire population through the use of specialist software that is able to interrogate a client's accounting records and look for the odd transactions, or examples of where the system may have failed. This can provide us with greater assurance that systems are operating properly than by simply using sampling techniques, and improves the overall quality of the audit work we do, giving us greater insight into how your systems are performing. So at present, we're working with a software product known as MindBridge and seeing how it copes with a range of different accounting software packages and business types. We expect to be rolling this out on more and more audit engagements over the coming weeks and months, including possibly your own. The exciting thing about MindBridge is that it also uses artificial intelligence as well. So the more data we put into it, the more that it learns what is normal and what is odd behaviour. So that brings us to an end of our today's webinar, and I'll now hand you back to Rachel.
Thank you. Unfortunately, we are running out of time, but we will ensure all questions asked over the course of the webinar are answered directly via email. Thank you, Peter, and thank you all for attending our webinar. A short survey will pop up as the webinar closes, and we would appreciate your contributions. As mentioned before, a recording will be sent to you via a follow-up email in the next few days, and we welcome you to respond and leave any feedback or send any questions you may have. We very much hope you can join us for a future Kreston Reeves webinar or event, and wish you a good afternoon.